Free and clear of the chatter from Wall Street, you're listening to Talking Stocks Over a Beer, hosted by hedge fund veteran and newsletter writer Mike Alkin, who helps ordinary investors level the playing field against the pros by bringing you market insights and interviews with corporate executives and institutional investors. Mike sifts through all the noise of mainstream financial media and Wall Street to help you focus on what really matters in the markets. And now, here is your host, Mike Alkin.
Welcome to the podcast. It is Tuesday, April 3rd, 2018. Hope you had a nice weekend. I had a fun weekend. We had my in-laws over yesterday for Easter, so it was nice to see them, and the kids got to play a lot with their cousins, so it was a good day. That was Sunday, but on Saturday, my wife, the weather was pretty nice over the weekend here in New York. So on Saturday, my wife said, my parents are coming, my brothers and sisters are coming, but I haven't been able to get a hold of Joe, the landscaper. Would you mind doing the yard cleanup for the season? Because it's really been the first nice weekend that we've had, and we have a landscaper that comes over. Doesn't charge a lot at all, comes over once a week, does a lawn and cleans it up and everything. But he does a nice spring cleaning at the beginning of the year. So my wife said, I can't get a hold of him. It's probably a little early. Would you mind? I said, okay. So I have a nice leaf blower. And so I went into the garage, got it started, and I'm starting to, you go into the back of the bushes and you blow out all the leaves, and you do it. I was doing it in the front, the side of the house, the back. I'm 10 minutes in and I'm feeling good, and it dies. The leaf blower is done. So I spend 15, 20 minutes applying all of my mechanical knowledge to it, which is about 14 minutes more than I am capable of, which is surprising because I grew up with my grandparents, Italian immigrants, and my grandfather was a longshoreman and a mechanic on the piers in Brooklyn, and he could fix anything. I can fix nothing. So it's pretty remarkable that even through osmosis, I wasn't able to digest or remember anything from growing up. But I try, and more often than not, I'll do something around the house, and my wife will just have to call somebody in to fix what I tried to fix and couldn't do. So here I am. I'm thinking, okay, so the leaf blower dies. That's great. So what? I'll get a good workout in. It's going to take me an hour and a half. So I'm about 2 hours in, and I'm starting to feel it. And my legs starting to feel it a little bit. Now over the winter, I probably put on 10 pounds, 15 pounds. I mean, I'll skate. I'll play a little bit of hockey over the winter. But, it's cold out. I'm not doing a lot of outdoor stuff. So I could fluctuate in the winter time. And then I'll lose as soon as the spring comes back. I'll get working out pretty quickly and stuff. But I'm not the ultimate gym devotee during the winter. So I thought it'd be great to get the workout in, but like I said, I'm 2 hours in and I'm starting to feel it every time I bend down, and it's not feeling great. But I'm motivated, I'm excited, and I'm thinking it's great day of spring. It's probably 60 degrees outside. 3 hours in, I'm starting to fade a little bit more, and I look around, I'm thinking, oh my God, I still have so much more to do. 4.5 hours in, I'm making some progress, but I'm feeling it. I mean, by this time, my back, the rake, my hands, I got blisters on my hands. Every time I bend over, I'm feeling it in my knees. And I've had knee surgery in the past, so it does come back to get me once in a while. I've got a bone spur in my thumb that's getting to me. So about 5 hours in, I have to go pick up my daughter somewhere. And 2 hours in, I texted my wife. She was out, and I said, "Have you heard from Joe?" She said, "No, I can't get a hold of him. I told you." I said 3 hours in, I text again, nothing. So I go get my daughter, and I get in the car, and I said, I felt good. I have a Jeep, so I have to climb up into the Jeep. Felt good. My legs were sore. I sit down. I drive 15 minutes to get her. I come back. Who's sitting there? Joe. Joe and his entire team of landscapers, 6 guys out I don't know what they were doing because I had pretty much done it all. But they found a lot of stuff that I couldn't do. But timing is everything, right? So we get done, and I go inside, and I am now I'm pretty wiped. I sit down on the couch. Now the Final Four was coming on, and I sit down, and I get a Diet Coke, and my son comes in. He's 12, and we play a lot of hoops. He plays a lot of sports, and he's good. He's 12, but he's about 5'7", and he could dribble, he could shoot. He's a good basketball player. And we play a lot in the backyard. And he said, "Come on, Dad, let's play." I said, "Hey, buddy, Daddy's not feeling so great." He goes, "Come on." Well, we go outside, and we play a three-game series to 11. You got to win by 2. So each game is up to 11, 1 point for a basket, and you have to win by 2. And normally, I would say up until a few months ago, if I was winning, I might hold off a little bit. And he knows the secret, though, because I'm hot or cold. If my jump shot's good, it's good, and he's got a problem. If it's not, he's like the Energizer rabbit, the bunny, so he never stops, and he could wear me down. Let's just say after 5 hours of landscaping, it was a no contest. He smoked me. So he was feeling pretty good about that. So that was my Saturday. Sunday, like I said, the in-laws came. It was pretty nice. It was nice to have everyone over, and wrapped up Sunday night with my usual routine with my wife, which is watching Homeland and then Billions. And here we are. So I want to talk a little bit about last week in the markets. It was interesting. So I think you've heard me say that it is been a bit of a seesaw. It seems like one step forward or 2 steps back. And I think if you've been listening to the podcast, you know that I'm bearish. But last week, the equities rebounded. It ended what was really a 2-week skid. And the NASDAQ, the tech-heavy NASDAQ, I should say, it was up about 1%. The S&P was up 2%, and the Dow rallied 2.4%. I love bringing the Dow in, by the way. I recall for years I forgot the Dow existed. It didn't matter. It's 30 companies. But normally you get to it when it crosses big milestones, right? I remember in the late 90s, it was Dow 10,000. And then not too long ago, Dow 20,000, and those hats come out. But normally when you talk about the market, it's the S&P. But the Dow has found its place again. It hovers where, I don't know, 24,000 or so. But Monday last week had a really big rally. I think the markets were up 2.5%, 3.5%. The different indexes, because the U.S. and China started negotiating on the sanctions and trade, and there was talk of there was less concern about the trade wars. And the week went on, and it was more in the bullish camp. Amazon, though, is under a little bit of fire. President Trump is all over them. Now Jeff Bezos, the owner of the CEO and founder of Amazon, he's also the owner of the Washington Post, which we know Trump feels about Amazon, the Washington Post, which is fake news, according to President Trump. And Amazon is coming into his crosshairs right now. He went on a tweet storm over this past weekend, talking about they not paying their fair share on shipping. So it's going to be interesting to see what happens there. And the other FANG stocks have been under pressure, FANGs being the Facebook, Google, and so on, over these data breaches and privacy concerns. And that has weighed heavily lately on tech. But what was interesting to me last week was 11 of the 11 S&P 500 sectors finished the week with gains. But it's not so much that. It's what made up the move. The less risky groups like consumer staples, utilities, telecom services, that's what drove the market. Staples were up 3.5%. The utilities were up 3%. Telecom services a little over 3%. And the tech sector was up 1.7%. Now, normally what you see or have seen over the last several years is what you would call the risk on trade, which is when people are feeling less concerned and the market's going up, you see rotations into riskier stocks. Obviously, tech has been on such a tear for a long time now. And when there is people are feeling a little more bullish, you see risk off. So people rotating in. That didn't happen. Here you had gains in the market, but it was the safety stocks, the safe havens that rallied a little, that led the market, which to me is something I'm watching because it's telling me the mood of the market is changing. So while we had a big move up for the week, it was the composition of that move to me that is, I think, worth keeping an eye on. So I get asked a lot, what do you like? How do you think about investing? I mean, what's your investment style, right? And I've talked about this before. And, for me, if you're listening to this podcast, it could be your first time or you're a regular listener. If you're a regular listener, you know that I'm what's called a contrarian, right? I am taking the other side of conventional wisdom, of consensus. I don't do that simply because I just want to be difficult or different. I do that because I think that there is less wisdom in crowds than one might think when it comes to stock prices. I'm betting against conventional wisdom because often what I find is that there's comfort in crowds. And when there's comfort in crowds, the narrative starts to take over. And I equate this back to what you will see professional investors do. There's something called the idea dinner. And the idea dinner is where a handful of folks get together and might go out to eat. And the purpose is to share investment ideas, sit around the table, have a few drinks, have something to eat, and it will go around the table and each person will pitch their best idea. If you're at an idea dinner and somebody pitches an idea that's very popular and the narrative is easy to adopt, you see a lot of head shaking and everyone says, yeah, that's right. Yeah, that makes sense. That makes sense. Well, a lot of that is probably priced into stock. And because people take comfort in crowds, they're sitting there and it's easy to agree with consensus. And what I like to do is but consensus is where the prices are already pretty much reflecting that view. And then, so if it's that view is widely held, then what takes the stock higher? Well, earnings can go higher. And if the earnings go higher and people paid the same price for that earnings stream, the stock's going to move higher just because the earnings have gone higher. If the earnings stay the same and the stock goes higher, that means people have paid a higher multiple on that earnings stream. So you have multiple expansion. Now, we've had a lot of multiple expansion. And what I think is interesting when I'm looking at this is I always want to ask myself, well, what's going to make somebody pay more for that earnings stream in the future? What is that piece of news? What is that information that people don't already know? What's the surprise? When something is widely held or the view is broadly known, it's hard for that surprise to move the stock. When you're a contrarian, and by the way, contrarian is both long and short. Now, I spent much of my career as a very aggressive short seller. And no, short selling is not a four-letter word. It's not bad guys doing bad things. It's people who have a different view on companies, who think that consensus is wrong and that the earnings stream or cash flows are going to decline, and it's not reflected in the price of the stock. And because there's so much risk, if you're wrong, right? So in the world of short selling, you borrow shares from an investment bank, you sell it into the market, you take the cash. At some point in time, you have to replace those shares to the investment bank. Now, your goal is you're going to go back into the market, buy those shares at a lower price, and you pocket the difference. But if you're wrong and the stock keeps going higher, at some point you have to go and replace those shares, and it can go to infinity. Right? There's no cap on how high a stock price can go. So that's an inherent risk in short selling. Now, because of that inherent risk, if you're going to make part or all of your living as a short seller and want to have any shelf life at all in doing so, you better do your research. You better be really good at doing your research. If you're having a contrarian view for the sake of being contrarian, you're going to have a very short career as a short seller. And you have to be selective. You have to look at what's out there, look at the research, and then whether you see something in the financial statements or you see something doing primary research, your work has to really be at a level that's different than the average bull on a stock. So now on the long side, you can be a contrarian, and you're just looking for things that are beat up and dead and left for dead, left on the junk pile. So where I tend to find those opportunities, both on the short side and the long side, I like to look at, if I think about my longs, I like to find very deeply cyclical industries where the cycle has extended for multiple years, where the underlying price of the product sold or the commodity has dramatically been reduced, and where the narrative is easy to adopt, where it's obvious. Everyone knows the problem, and the stock prices are reflecting that. And it's there where I'm looking for changes on the margin that are going to make a difference. And it's there while I'm doing field work to try and identify where consensus could be wrong, where everyone knows what the bear case is. And then I'm factoring in what's my risk reward. So I look and say, okay, if I'm wrong, and I can promise you I will be wrong, I can promise you most people, everyone will be wrong. Not most, everyone. That's something else when you get a lot of these inbox in your newsletters and you hear about gurus and how many people got this one right and that one right. Ask them what they got wrong, because I can promise you they did. I do. We all do. So as I'm thinking about risk reward, what I'm thinking about is, if I'm wrong, how much lower is the stock going to go, or the group of stocks going to go? And what's my reward if I'm right? Is the sector so beaten up? Is it so left for dead that if my work is right, how much am I going to get paid on that? And then that goes a long way towards determining how big I make the position. So if I find a company or a group of companies or a sector where the narrative is so long in the tooth, where the stock prices are so beaten up, where I can find, by doing my own research, that aha moment where I think they may have it wrong, and I think that the upside dwarfs the downside, that's going to go a long way in determining my position pricing, my portfolio positioning. Now, there are sometimes I'll do that where I may find a very interesting little speculation where if I'm wrong, it could go to zero. But if I'm right, it could be a 10 bagger, a 20 bagger, a 30 bagger. But if the probability of going to zero is high, because it has to go through a litany of things to make it work, it's going to be a very tiny position. But you take a flyer on it once in a while. And then there are those industries where you look at it and you have to do a double take and a triple take and say, wait a second, I must be missing something, because the asymmetry, the risk I'm taking is so small for the reward that I can get that something doesn't make sense. And once in a while in your career, you find those things. And it doesn't happen often. And that's why, by the way, the guru trade, when you follow the gurus, if somebody made a phenomenal call and it was market moving, they caught lightning in a bottle, it's hard to do it 2, 3, 4 times. So, it's about, what have you done for me lately? It just because you found something once doesn't mean you're going to find it again and again and again. But when you see those, you really have to pay attention. So how do you look for that? And I call it the 5-minute grits in a group of people who are too clever by half. And that's what I'm looking for. I'm going to say that again. I'm looking for 5-minute grits in a group of people who are too clever by half. I am a fan of stupid comedies. And my favorite movie of all time is My Cousin Vinny. And if you know My Cousin Vinny, maybe you just chuckled. And if you don't, I'll give you a very quick synopsis. 2 college kids are going from New York with thick New York accents, are heading out to California to go to college. And they drive through the deep South. And they pull into a convenience store. They grab a few things. They leave. And unbeknownst to them, right behind them came another couple of guys driving the almost identical looking car and went in and shot the clerk and killed the clerk. Well, a few minutes after leaving the store, these guys were pulled over, and they thought it was because they accidentally took a can of tuna fish, which they had accidentally. But it wasn't. It was because the eyewitnesses to the event identified this car. And on these small back deep South roads, the police found this car and they pulled these guys over, and they were on trial for murder. They didn't do it. But they didn't have any money, so they called in one of the guys, William Gambini, called in his cousin Vinny, Vincent LaGuardia Gambini from New York. And Vinny and his girlfriend drove down to Alabama to defend these 2 youths. And they drove down, and Vinny was a character. He was a guy who had failed the bar 6 times, and maybe 7. And he just couldn't get on the right side of the judge. Everything was going wrong. He didn't have the right clothes. He had never tried a case before. He had no idea what he was doing. But he was smart. And in the course of their first couple of nights in this small little southern town, they weren't getting much sleep. And in the morning, they went into the first coffee shop they could find. And on it, the menu said breakfast, lunch, and dinner. And that was it. Nothing else. Breakfast, lunch, or dinner. And so they ordered breakfast. And the short order cook was making grits, and they had never heard of grits. And they asked how grits were made, and they said, well, grits are made, and you can soak them into water for about 20 minutes. And that stuck in Vinny's mind. He didn't know it at the time, but it did. And it turns out during the testimony, there's a Mr. Tipton on the scale who lived across from the Sack of Suds, the convenience store. And Mr. Tipton was asked by Vinny, how do you know it was those boys and not a similar looking car? And he said, because I know I was making my breakfast, and when I came back, I saw the boys leaving. And he said, are you sure it couldn't have been more than a few minutes? He said, what do you have for breakfast? He said, eggs and grits. And Vinny asked him what kind of grits he has, instant or regular. And he said, well, no self-respecting Southerner eats instant grits. And I got a chuckle from everyone. But Vinny said, well, how long did it take for you to make those grits? And Mr. Tipton said, 5 minutes. And that caused Vinny to pause. He said, wait a second. Are we to believe the law of physics ceased to exist on your stove? It takes the rest of the grit-eating world 20 minutes for the water to soak into the grits, but on your stove it takes 5 minutes? And Mr. Tipton said, well, I guess. And the questioning went on. And it turned out that Mr. Tipton said, well, I guess you're right. It was 20 minutes. So what I'm looking for is those 5-minute grits for groups of stocks that are so beaten up that everyone is so sure of the narrative, so convinced it is what it is, that what they're really seeing is completely missing what's really going on. In the world of equities, a lot of times in these deeply blown up industries, there's change occurring. But human psychology is such, and the comfort of crowds is such, where they take comfort in crowds. And if everyone's saying it, it must be so. It must be 5 minutes from the time he put it on the stove to the time he saw the kids leaving the sack of suds. But if you drill down, you might find that it really was 20 minutes. So I'm looking for that. And then the group of people investing in it are too clever by half. They're too cocky for their own good. And there's nothing really. They've got the narrative. They feel good about it. They're feeling pretty confident in it, but not having done much work on it. They may have done work on it, but they're so confident in their narrative that they're too clever by half, and they miss what's going on underneath. And so for all the spreadsheet work I do and all the reading of annual reports and all that stuff, my best ideas come from looking for 5-minute grits in a group of stocks where the investors are too clever by half. And if some of you know, have seen me talk at conferences, you will know that I think the group of stocks, the sector that I think has the best risk reward of anything I've ever seen in the market in my entire investing career is the uranium sector. Uranium, yep, that's the stuff tied to nuclear power. It's the feedstock for it. And that to me offers so much asymmetry, so much upside and de minimis downside that I'm willing to wait. And if you're an individual investor, it is something that is really beautiful right now because this group of stocks has gone from, well, the commodity has gone from 137 a pound years ago down to about $21 a pound now. The number of companies who are in the mining business have gone from 500 down to about 40. It's been decimation. And the market cap of the industry has gone from about $60 billion down to about $6.5 billion. I haven't looked in the last few weeks, the market cap, but it's gotten crushed. And because of that, most of the professional investors can't invest in it. The industry is too small. If they wound up putting the big sums of capital they have to work, they'd buy many of the companies, and they can't do that. So it eliminates this massive swath of companies or of investors, mutual funds, hedge funds. They can't play in the space. That's good. And then in smaller funds, if you're running a small $100 million hedge fund, 50 million, 75, I say small, right? You hear, if you're an individual investor, you hear, well, $100 million isn't small. In the world of professional investing, managing that amount of money is relatively small. They have finite resources. They have a couple of analysts, maybe one or two analysts. And the uranium industry is the most opaque, complex industry I have ever looked at in my entire career. Nothing comes close. And the sell-side firms, the investment banks that write research on these companies, almost all of them are gone. They've left because they can't make money. Their big clients can't invest in the stocks, and there's not a lot of investment banking fees. So if you are a small fund trying to get up to speed on the uranium sector, you don't have the capital resources, the human capital resources to devote an analyst to spend months and months and months and months getting up to speed on it. And that's how long it will take without the benefit of a sell-side analyst research report telling you about the fundamentals. And what's out there is kind of dated right now. And so you have this kind of vacuum, this void, and where the big investors aren't there, they can't be yet. The small investors don't have the resources. You have a group of stocks that are so beaten up. But the reality is the uranium miners sell into a end market called nuclear power that's going to grow 2.5% to 3% a year. It's a growth business. So I mentioned earlier, people are out buying consumer staple stocks. Yeah, that's great. So go buy consumer staple stocks that are trading at peak margins, peak valuations, have basically no to little revenue growth, have already cut all the expenses that they could out of their business model, have financial engineered their way to earnings growth over the last several years by borrowing cheap money to buy back stock. But the core business stinks, and that's considered a safe haven. Yet a group of stocks that mine something that goes into a business that provides 11% of the global world power, 20% of the U.S. power grid, that's growing 2.5% to 3% per year, that is mired in a 7-year-long bear market, nobody wants to pay attention to it. And that's where being a contrarian can be beautiful. Now, you may have to wait, but if you are an individual investor, you can wait. Big funds can't. They don't have the time. Even if they could invest in the space, which they can't because it's too small, they don't have the benefit of time. They're judged every day, every quarter, every week, every month by investors. They can't wait a year. They can't wait 18 months. But if you step back and you look as an individual investor and say, oh my God, I have something where I have de minimis downside and upside that's tremendous. So what? Wait. So I'm going to bring in a guest for the interview portion today, a friend of mine who is a 30-plus year industry veteran in the uranium sector. He's the former president of Cameco North America, and he is the president of Uranium Energy Corp, and he does advising to Uranium Participation Corp, I believe. And he also advises Kazatomprom. So without further ado, I'd like to welcome Scott Melbye to the podcast.
Great. Thanks, Mike. As always, it's great to sit down with you and be with your listeners today. Thanks.
You bet. How was your vacation? You get some rest?
I did. Yeah, it was good. Got down to Mexico for a couple of days with the family, at least the kids that are still in school. And yeah, we had a great time, but ready to get back at it.
You got uranium on your mind?
So, Mike, we definitely do have uranium on my mind, and I'm quite encouraged by a lot of the long-awaited catalysts that are now finally coming to fruition. And so it's a good time to sit down with you and your listeners to discuss what some of these catalysts are, some things that we should be looking for, and kind of give you my views anyway of where we're at in the uranium market.
Great. So, Scott, let's take the listeners back. Let's give them some background on you. Now, you and I, so we have something in common. Mine's a lot better than yours. So I went to the University of Arizona, and Scott went to Arizona State. So we're going to let that pass right now. But we're about the same age. And aside from the fact that he chose the wrong school, well, I went to Arizona originally. We'll let that pass. But why don't you take listeners back to, and I don't want to hear it, by the way, from ASU fans. I went to the U of A, yes, and if you don't like it, just deal with it. But Scott, take listeners back to what you did when you came out of school, when you were in the uranium space, so they get a sense for your experience in the sector.
Sure. No, and Mike, you know you are my best friend from the University of Arizona. So might be my only friend, but you are my best friend from there.
Excellent.
Mike, I graduated from Arizona State in 1984 and really wanted to focus on the resource industry more in the business and finance side of the business rather than the mining, engineering, and geology, which would have followed in my father's footsteps. But I was more intrigued by the commodity side, and I joined Nuchem Inc. in New York at that time. They were still independent German trading company. This was long before they were acquired by Cameco. But it was a great first experience in the industry in '84 to really get a feel for the players in the business internationally and get a feel for supply and demand at that time. But shortly thereafter, I had the opportunity to go back to Arizona and join the nuclear fuel management group at the Palo Verde nuclear stations. And so I took that opportunity to really get a feel for what it's like to be a fuel buyer, what it's like to plan uranium inventory policies, and understand the fuel management principles in a nuclear utility. I did that right up until the end of the 80s when one of my suppliers at the time was Saskatchewan Mining and Development, and they were going through a merger with Eldorado Nuclear to form Cameco. So I took that opportunity to move all the way from Phoenix, Arizona to Saskatoon, Saskatchewan, and began what was a 24-year career with Cameco, and in all aspects of their marketing and sales, including president of their global marketing subsidiary. So that was an amazing opportunity to literally sell uranium to every electric utility company in the world, in Asia, South America, Europe, North America. In 2010, however, I made a change to still with one of the majors, one of the top 4 producers in the world was Uranium One, and that brought kind of a continuation of some of the experiences I had gained in Kazakhstan through Cameco, but joining a company that was being taken private by the Russians, which we all know is quite public in the press these days. But it was a great experience to join them and advance relationships in countries like China and in the Middle East and the United Arab Emirates. But it was really only about 4 years ago that I was able to join Amir Adnani at UEC and really do something entrepreneurial. And instead of being with one of the large cap major companies, this gave me an opportunity to really build something from scratch. And that's what we're doing at UEC. And I have to say it's probably one of the most rewarding times in my career is to really just take something and build it up and build the asset base and de-risk the assets and get them ready to go when the uranium market finally turns.
So, you've seen it from both sides of the aisle. You've seen what it's like to be a fuel buyer, and you've seen what it's like to be in the mining industry. And I know you spent a lot of time in Kazakhstan, and we could talk about that in a little bit. But so, Scott, the industry is so fascinating. Right after Fukushima in March of 2011, it's just been decimation. And it's fascinating when I started really honing in on the uranium space a couple of years ago. I've always spent my career looking at deeply cyclical industries for the most part. I've looked at others, but I find that at big peaks and big troughs, you can really find some interesting investments either on the long or short side. And with the uranium space, because it is so complicated and opaque, it makes it even more interesting. But one of the things that struck me was a couple of years ago, the commodity had been down. It was high 20s, low mid 20s, and I'm looking at the space, and what struck me was how stupid are these miners? And here is an industry where demand fell off a cliff when Japan went offline with 54 reactors shutting down. It was about 13% of world demand that went offline, but the miners were still pumping uranium out. So I didn't understand. In many industries, when there's demand like that gets shut down, the normal response is shut off supply, or at least start to shut supply. But you saw capital expenditures and drilling and everything keep increasing. Mine production, primary mine production kept increasing. And as you start to peel the onion back, you realize, well, that's because the miners are living off of these long-term contracts, these 7, 10-year deals. And it wasn't until really in the last year or so that this big waterfall of contracts were expiring. And you're starting to see people who were working off of $60, $70, $80 pricing now having to go in and enter into contracting in the $20 and $30 range. And that's not really going to work. So, Scott, for listeners who may not be familiar with the dynamics of the contract market, of the spot market for uranium, why don't you get them up to speed on that?
Well, it's probably one of the most important things to understand in the uranium market is that we are obviously a commodity, like any other commodity, but we're nowhere nearly as efficient and mature a market as, say, other precious metals or base metals. I would dare to say that in the copper industry, if you heard the Escondida mine was being shut down for 10 months in Chile, we would have a rise in the copper price almost instantly. And I think that's one of the frustrations, one of the most common asked questions I get from investors today is, okay, all these production cuts are now happening, well, why isn't the price responding? And the answer is be patient because, we don't, I don't think the fundamentals of supply and demand react in real time as they would in a more efficient market where there's a lot more volume traded on a daily basis. And you've touched on it. The lag times that we have in our industry are profound. And so we have, it takes a very long time to get mines into production because of the unique permitting of not just mining permitting, but uranium mining permitting. So when you set that cycle in motion, it could take 7, 8, 9, 10 years to bring a mine in production. So you could be beginning that mine development in a very different market than where you end up when you finally start operating. You've also touched on the hedged contracts. I think as a commodity, we have a much greater percentage of hedged forward contracts, which, gives stability for some producers who choose to hedge their production forward, obviously protects them in the downside when prices fall, but that also has the distortion of continuing to support what might otherwise be uneconomic mines that have much higher production costs than the current spot price. Now, that is being that's really coming to a head now as all these old contracts that were signed, and we had some pretty profound peaks in the uranium price in the last 10 years. In the 2007 period where we saw prices over $130 a pound, we saw $70 a pound right before Fukushima. A lot of contracts were signed in that period, and that's what these higher cost producers have been surviving under. And so, as those contracts roll off, if they have $65 plus production costs from a big conventional mine, and they're now forced to sell at $22 in the spot market or $30 in the long-term market, the decision is going to be quite easy, and that's what we're beginning to see. Even big companies like Cameco that have outstanding assets in Saskatchewan, even they realize that to continue to just produce those world-class assets into a depressed market and not cut back would just be insane, and they'd be hurting themselves in the process. So you can see that in their decisions, not only at McArthur River, but Rabbit Lake, and also their U.S. operations. Having worked with the Kazakhs, I'll say they're going through a very similar rationalization of their production strategy. And, I will say that it's been a profound change there where, it wasn't that long ago that they were operating under the state-owned mindset of just produce, more is better. But now I can tell you, especially if they're looking ahead to an IPO and certainly looking to, produce profitably from those operations, they're realizing that they have to do some rationalization of production at their mines and their joint venture-owned mines. And so that's something that they've been dealing with in 2017 and working through their joint venture partners for production levels over the next 3 years.
And for listeners who don't know, the uranium mining industry is highly concentrated. The Kazakhs, through their state-owned company Kazatomprom, control 41% of the world market. So think of them as what Saudi Arabia is to oil times 3.5, if you will, in terms of market share. And the Kazakhs produce about 24-25% by themselves, and the balance of that 41% comes through joint ventures. And they're a low-cost producer and have been pressuring the market, and we'll talk why. Besides low cost, the mechanism by which they've had to sell into the spot market. But Scott, one of the things when you look at the existing narrative on uranium, it's interesting that the bears will say nuclear power demand is declining and cheap natural gas is a big threat. Japan has been very slow to come back online. There's way too much inventory. There's too much secondary supply. And we're going to touch on all these things. But what's interesting to me is when I was coming a couple of years ago, and I devoted all of my time after my sniff test said, wait a second, there's something really interesting here. There's more nuanced things so go at play here. And some of the things I didn't see I still don't see talked about a lot is, so these contracts, and I know you know this, Scott, I'm talking for the benefit of our listeners, but I'm going to ask you to comment on it. Before the Kazakhs were the Kazakhs back 10 years ago or so, 9 years ago, were less than 10% of the world market, and that's now 41%. And through some transfer laws that were put in place in Kazakhstan in 2009, because the Kazakhs were worried that there was tax evasion taking place. And so they were worried that people in the oil and gas and the mining industry were pulling stuff out of the ground and not giving the Kazakhs their fair share. So they put in laws that said if you pull something out of the ground, you've got to sell it into a market where there's a spot price. And in the rest of the commodity complex, that's so. But in the world of uranium mining, because security of supply is far more important to a nuclear power plant than the price they pay, because the cost of uranium it could be 5 to 10% of the overall operating costs. But if you don't have uranium, you don't have nuclear power if you don't have that fuel. So they always entered into long-term contracts. But because the Kazakhs had low costs, cheap labor, and their mining methodology, and they had to now sell into the spot market, after Fukushima and demand started to wane, they were pumping uranium in because these mines are in remote areas, and the cash flow from these mines go to pay roads and schools and healthcare. So they needed to produce it, and that kind of worked that way. Now, so you saw this during a downturn, the Kazakhs take massive market share. But what's interesting is most of the time, Scott, the contracts for uranium between the mines and the nuclear power plants were 7 to 10 years. And right. we saw Spot take a big role, as I just say. But another market has developed over the last few years, which is a more intermediate term market, which is 1 to 4 to 5 years. And what I don't see get talked about is why that developed. And it's something that I think ties back to what we would call the carry trade, which is where, because the cost of money has been basically zero with 5,000-year low interest rates, if I'm a uranium or if I'm a nuclear power plant, I could either buy it and hold it for the future at today's low prices, or convince one of the few trading houses of uranium to go do that for me. So as I started to peel the onion back, what I didn't see was, wait a second, if you believe interest rates are always going to stay here, that's great. But if you believe that world economy picking up is going to lead to increasing interest rates, that's going to have an impact on the counterparties to the carry trade. So Can you talk about the carry trade and what impact you think that has had on the uranium market?
Yeah, it's really been profound. And I think to people who invest in commodities, they're going, why is the carry trade something more recent in the uranium market? I mean, that's something that's quite commonplace in other commodities. But
Yep.
It was really something that developed really within the last, I would say, 10 years. And it was really brought about through Deutsche Bank and Goldman Sachs, who looked at the situation and said, hey, through the Fed policies, we're essentially getting free money. And if we can buy the spot uranium today and sell it to A-rated utilities and utilize that low cost of money and sell at a fixed price 2-3 years from now, they'd do that all day long. And utilities also thinking, wow, we can lock in today's low prices for 2-3 years into the future by taking advantage of it. It's become a very big feature of the uranium market, and it's really changing. Before that, you had a spot market, which was traders, producers, everyone, in that 1 year or less market, and then you had the long-term market, which was the realm of the producer who dictated what those terms were, and then this medium-term market has really kind of bridged these two markets. Now, I think it has been fairly damaging because this has come at a time when we've had very low interest rates and very low uranium prices. But I do think it's an efficient aspect to any market that helps rebalance things much faster than they would if you didn't have that carry trade activity. And while it's been painful, as you've mentioned, we're now seeing a point where that could change pretty dramatically because the value of the carry trade is cheap uranium, low interest rates. If both of those head north, suddenly that carry trade isn't an option, and you're basically looking at, okay, do I buy spot and carry it on my own books, or do I contract with producers at their terms, which reflect more the cost of production and the ability to discover, find, develop uranium.
And Scott, if I look at right now, if I look at 3-month LIBOR, the London Interbank rate, it's gone from 1.15% a year ago to 2.3%. I mean, it's doubled basically in a year. And we're starting to see, right, the Fed is hiking rates, and I just don't see it talked about a lot in at least in the uranium investing space. And I mean, if rates keep going, I mean, to me, this could really impact that carry trade market.
So absolutely, and again, it's just it's a function of those two key factors. And if uranium prices increase and interest rates increase, suddenly that carry trade, doesn't look as interesting. And, it goes hand in hand with what's happening in the market. I mean, we've been for decades a inventory driven market, which any economist would tell you, it's not a good situation to have your the marginal source of supply being inventories, because they often don't have the same cost of production basis underlying them. But we're now rapidly getting to a point where where we need new mine production. I mean, we've been consuming more than we've been producing since the late 1980s. So this has been a massive drawdown of over 1 billion pounds of excess secondary supplies. But, with this change in interest rates and our spot market increasing, if that happens at a time where we're also transitioning into this market where new mine production is needed, well, remember what we said about the lead times to bring on new mines. It could be 6, 7, 8, 9, 10 years. You then have a very interesting investment thesis where the uranium price could increase pretty dramatically, and production doesn't increase. This dysfunctionality of the uranium market just doesn't work one way when it's oversupplied on the downside. It also helps things spiral upwards when the supply and demand goes into balance or even shortfall. And I think that's what we're going to be seeing now in the next couple of years, is that play out.
Scott, another thing I don't see talked a lot about, but I think has had a profound impact on the market, is the depreciation of the Kazakh Tenge against the U.S. dollar, which in 2015 was devalued, and the Tenge has declined about 80% against the dollar. Can you talk about the impact that has had on the Kazakhs?
Sure. And, one, I should say that, the Kazakhs do have some of the lowest cost mines in the world. The Karatau mine probably being the lowest cost producer in the world, but not all of their assets are of that same quality. So they have a range of production costs. But if you took on a net basis across the board of their entire portfolio of some 20 mining operations, they were getting down to a point in recent years when you approached the $20 a pound level, there were alarm bells going off, not only within the energy ministry and Kazatomprom, but also with the president himself, who again worried about the shrinking profits from the uranium mining operations, not being able to supply and support social infrastructure in those rural areas. And I remember being in an all hands meeting in Astana, where the CEO at the time, who I was advising, was giving a talk to everyone and saying how important it was to adopt, better business practices that allow them to compete, meaning lowering costs, coming up with digital controls at the mines, anything they can do to remain competitive. But he gave a very strong caution to everyone in the room, and this included all the mine managers from those operations, was that if anyone thinks that the depreciation of the tenge is going to save us or your particular operation, forget about it. That's a crutch. It's something, one, you don't control, and two, it's not something you count on going forward. And so I think they're very, and I think that's a very wise approach, is that, okay, they did get a little breathing room, definitely breathing room, by the devaluation of the tenge.
Because their costs are in tenge and they sell in dollars.
Exactly. But they know that you can't count on a weak currency continuing. And, they're a very heavily resource-driven economy, largely oil and gas. And so if you see oil and gas prices recovering, you see the tenge recovering. And so that, that benefit goes the other way. So, again, this thought that they can just produce at any price level is just not accurate. They're feeling real heat and pain at these current spot levels, and that's why they've been forced to take dramatic steps both on the operations side and on the marketing side and strategic development side, to change the way they operate.
Scott, as somebody who advised the CEO for a few years, can you talk about the transformation that you saw from when you first went over there? I guess how often were you going over, and kind of the mindset shift that you've seen over the last couple of years?
Yeah, well, I was traveling over there at least once a quarter. And, I think they still have a long ways to go, but I look at the improvements that have been made over the last 2 or 3 years have been pretty profound. When I got there, you still had a post-Soviet state-owned company that, again, when you ask them about their strategic development process, there was just, there were crickets. And, the thought was, in the old Soviet days, produce more. More is better. If it's widgets, uranium, anything else, just try to produce more, and that will get you recognized, and that will be a good thing. But we very quickly then showed them the economics of why that isn't the case in the market today. And, producing more and more pounds, simply reducing their own profitability and depressing the market, which, as a largely spot market or spot index seller, they were just killing themselves at that rate. So, I have seen a real awareness, executive level and the operations that, hey, maybe we do need to be a little more strategic with the production levels. On the marketing and sales side, which was my focus, I've really seen them really try to transform and adopt, and certainly, what I brought to them were the best practices of some of the best marketing companies in our industry today, companies like Urenco, companies like Cameco, and others, and try to instill what has worked for those companies for the Kazakhs. And I think in the process, this will really lift their game, allow them to be, more diversified seller, not depend so much on China, although it's great to have a customer like China right across the border from them. But again, I think this whole lifting of their game in the area of marketing and sales can't be anything but positive for the uranium market going forward. I think you're going to have I think you already do have a much more responsible party managing 40% of global supply. Part of that, and I know you've talked about it quite a bit with your listeners and readers, is the THK entity, which was in Switzerland. And this is interesting.
Yeah, so Scott, not to interrupt you there, but it's called Trading House, just for listeners, Trading House Kazakhstan. It's a new entity that has been established in Zurich, Switzerland, right, which for the first time, if any major commodity producer in the world trades their own commodity. The Kazakhs did not have that. So correct, they also were able to when they had to pull out of when they were pulling it out of the ground and had to sell into the spot market, they were depressing the market. And now with this subsidiary that has a balance sheet in Switzerland, the Kazakhs can pull it out of the ground and now have some optionality. They can choose to buy it from themselves and pool that inventory, or they can just be more of a market participant and have more of an influence in the market. So that's what Scott's talking about with THK. So Scott, actually somebody, and I won't mention, but somebody was out recently in the uranium industry said, it's just a myth, THK. Why don't you comment on that? Why don't you comment about what you've seen over there?
Well, I can tell you THK is very real and it's up and running today. And, one thing that's important to note is that when you hear of a Swiss entity being set up, it's usually for the purpose of tax optimization in a global organization. But this really isn't, as a state-owned entity, it's not as much tax-driven as it is to give them more flexibility as a marketing entity. So for their production, which was marketed under those very inflexible transfer rules, pricing rules, they still meet the transfer pricing laws of Kazakhstan, but they're met in the initial transaction with the Swiss company. But then you're right, they do have the ability to sell under fixed prices or market-related prices, or they can, if the market isn't ideal, they can hold back and not sell the material and build up inventories. That's something they couldn't do under the transfer pricing. They had to get paid, sell and get paid for the material they export within a very short period of time of the material leaving the country. Well, now they can be more like Cameco. They can build up inventory levels at all the various conversion facilities around the world where the uranium trade actually occurs. They can build up those inventories. Logistically, it makes them much more effective as a seller. But it also does allow them to engage in the market as a trader. And, we've seen that with most major producers have incorporated some element of trading to their core uranium marketing and sales activities. And I will tell you that THK has two gentlemen that are, being 12-hour time difference, at least from where I'm at here in Denver. They are coming in late in the afternoon, Kazakh time, working all through the night, and they're in front of their screens, and they're just doing nothing but monitoring and interacting in the uranium market on a daily basis. That's something that was unheard of 2 years ago in Kazakhstan. And, listen, as a capitalized trading company in Switzerland, they're able to jump in when there's periods where, let's say, traders are pushing the price down at month end for their own purposes. THK, Kazatomprom, can now step in and say, we'll take advantage of that market development and pick up the material and can essentially defend the price in periods of weakness, much like Cameco and other producers may have done in the past. So it is a very real development. And again, it is positive for the market in that it's just a much more savvy entity marketing this uranium than you saw in past years.
I've had people on Twitter ask me, or people email me separately and say, well, if they're in the market, how come the price hasn't gone through the roof? And it just really opened a few months ago. And you mentioned I have a couple of guys there, and it's not easy finding really good uranium traders around the world. There's not many of them.
Right.
But I mean, it hasn't ramped right away, but I would think that they wouldn't want to be in just gobbling it all up right at once. I mean, how do you think about that?
Yeah, I mean, they had to capitalize the entity. To be an effective trading company, you need a pretty big capital basis behind you. In their case, they were quite fortunate in that the Kazakh sale of their 10% interest in Westinghouse occurred, bringing in about $550 million. And that money, as I understood, has gone into the THK entity. Now, I don't know that all of it will be directed to trading, but a good portion of it will. Again, you touched on staffing. One of the things that they do need to kind of come to grips with is, they haven't really transitioned from the state-owned, pay scales. And so it's very hard for them to go out and acquire, 30-year talent in the uranium industry, to staff these things. They do have Riaz Rizvi, who's the chief commercial officer there, who does come with extensive trading experience. But in terms of the daily traders, what they have done, and Kazakhstan is a country that has, young generation of highly educated, very Western, younger people that have been, studied abroad at Wharton, at Harvard, at Oxford. And so, what they're doing is they're tending to develop that expertise homegrown. Now, we all know that that may take a little bit longer than if you buy off-the-shelf expertise, but in the process, they are developing a group of uranium professionals that again are kind of being brought up from the farm team rather than acquiring the big stars. So that will cause this to be a little longer transition than would be normal, but it's not a bad strategy.
Well, you and I had dinner with Riaz in Toronto last year with some utility buyers, and I was very impressed by him. It was interesting, right? There's a guy living in London who did not need to go to Astana, Kazakhstan, or Zurich, Switzerland to work for the Kazakhs, and he at dinner saw that transformation over the years. So you have a very, very Western commodity trading oriented person now leading that team. So it seems like they're on the right footing right now.
Yeah, no, and I think both he and I looked at our involvement with Kazatomprom kind of from the same perspective, is that we looked at it as a professional challenge and being able to be part of something, big. I mean, the transformation of the world's largest uranium mining company in the marketing and sales is a pretty big deal. And so I think that's why Riaz is there and has continued to contribute very positively to that process.
So let's talk about the market itself. So without getting too far into the numbers, the world, like you said, going back for many years, has been in a primary mine deficit. So there's more demand than there is supply. And as I think about that, well, how do you have pricing that's down 90% from its peak? Because there's secondary supply. And right. That secondary supply comes in the form of underfeeding, which, without getting into a physics discussion, it is when the enrichment plants are able to squeeze out more enriched uranium product to sell into the end market. So that has created a secondary supply. We had the Department of Energy in the U.S. paying for a cleanup of a couple of facilities, and they were bartering for those services. So they were giving away uranium that was pumping some uranium into the market, and a few other items of secondary supply. And basically, when I started looking at the space, Scott, it was, probably the market was oversupplied when you added up primary mine and secondary mine supply by 15 to 20 million pounds. Now, I will tell for listeners, the enrichment world is a very interesting world, and it's a critical part of the nuclear fuel cycle in that uranium comes out of the ground. I'll walk you through real quick the nuclear fuel cycle. Comes out of the ground and it gets crushed into something called yellow cake. And then it gets sent off to a conversion facility where it's turned into a liquid gas called UF6. And then from there, it gets moved on to the enrichment plant. Now, when it comes out of the ground, it comes out at 0.7% energy content. It can't energize anything. It's at the enrichment plant where they move it up to 4% for nuclear power or over 85% for nuclear weaponry. Now, so the enrichment portion is very important. But the ones who own the market shares there, the Russians, through a company called Tenex, have over half the market. And then there's a Dutch, English, German conglomerate that is private called Urenco that owns 35-ish%. And then Areva, well, they're called something else now, but the French nuclear power company has the balance, and the Chinese have a little, and there's a smattering. But it's basically Urenco and Tenex that dominate the market. And they had during this downturn, they had some excess supply and they were pumping the market. But Scott, talk to listeners about the enrichment market, because what I find interesting it's really complicated because they're not public companies. They don't have to tell you too much. And you have to go through some old filings. They do have debt, so they do file some stuff. But it's not easy. What you're trying to do as an analyst is find the number of SWU. It's called a separative work unit is what they work in, and they make EUP and enriched uranium product. And there was excess supply of SWU. There was 58 million units of supply and at the trough 48 million units of demand. And SWU is priced now at about $40 per unit, but it was priced $150, $180 per unit. So just like uranium mining companies who were working off of much higher order books, so were the enrichers. And they were getting $150, $180 on long-term contracts. And now if they go into the spot market, it's $40. So that has changed the dynamic for the underfeeding to occur. They're not selling it for what they used to. So Scott, what's your sense about what's going on in the underfeeding market?
Yeah, it's been a profound source of supply that's been meeting the gap. Obviously, if production is well below reactor demand, the secondary supplies have been meeting the gap and have been in excess to that gap. But 15 to 20 million pounds of that has been this underfeeding by enrichers. And it really came about, if you just take Japan, for example, when the Japanese utilities shut in their units, they by and large had take-or-pay contracts with uranium producers. So companies like Cameco and others continue to make the sales to the Japanese utilities, even though they're not operating. Now, they might have negotiated them, stretched them out, done some workouts with them, but they're continuing. With enrichment, it was largely a requirements-based arrangement, especially with companies like Urenco. And so with no reactors operating in Japan, Urenco was selling nothing into Japan suddenly, and it's been the case now for 7 years. That caused a lot of excess capacity to be freed up for this underfeeding process, which is just basically the analogy is like making orange juice. You can use more oranges and just squeeze them lightly to get the same amount of orange juice, or you can use fewer oranges but really put a lot more work and effort into squeeze that same amount of juice out. And that's what they're doing to spin off excess supplies. Now, the good news is we've probably seen the peak of that contribution given the fundamentals of the SWU market and everything else. What will be very beneficial there are two things. One, the enrichers have completely scrapped their expansion plans for new centrifuges. And in fact, they've gone and are looking at shutting in some of their first generation centrifuges. So basically shutting in some existing capacity. The other thing that will change the dynamics of underfeeding is just take Japan. While it's been a very painful 7-year process, we did see very big progress in 2017 in terms of plants finally beginning to restart in a meaningful way, to a point now where we have 7 reactors operating. We'll probably have 2 more restart this year. And so we're clearly kind of underway to get Japanese nuclear energy contribution back to about the targeted 20 to 22% of their electricity need target that's been set. So as they start to utilize their centrifuges more for their core business of enriching uranium into enriched uranium, and having less capacity available due to some of these retirements of the older centrifuges, the dynamics of underfeeding goes the other way, to where it not only reduces, but completely swing the other way in an extreme case. So again, it's been something that's been painful because it's, as I said, you could account for 15 million, maybe even 20 million pounds a year from this method, but it's something that's probably seen its peak and is probably heading the other way in the coming years now.
And also, so you have the pickup in demand, but you also see economics come into play for them too, right? When you're selling in an order book of $150 or selling it spot at 90 or 80, it's different. But when you're selling it at around where your cost is, that kind of matters, right? So it's
absolutely.
So, Scott, one of the things when I really started diving into the uranium space, what struck me is when I'm looking at these deeply cyclical industries, I like to look at what drove prior cycles. And when I went back to the prior turn in 2003 of uranium, I saw there were 23 new reactor builds scheduled to come online and about 44 million pounds of new primary mine supply that was scheduled to come online. And I look around the world today and I see that there's a roughly 60 reactors scheduled to come online. And when I looked at the new primary mine supply, with the exception of a handful that could come online at around $40, there's basically no major mine supply coming online. So you have almost 3x the number of reactors coming online than the prior turn. You have dramatically less new mine supply coming online. And then I modeled out every prospective mine in the world, and the light bulb went off for me. I said, for new mine supply to come online, what's it need to be? So I went country by country, and I looked at all the economic studies on the mines, and for any meaningful new supply to come online within any time frame that approaches this cycle, you need $50+ uranium. Now, there's a few mines at $40. Some could come online for ISR mining, which is a lower cost to start the mine, could come online at $35. But the supply from that is de minimis. It doesn't matter in the world dynamics. So you have the dynamics in the marketplace, much greater demand. You have 750 billion under contract in reactors. You need the price of uranium to go up 2.5, 3 times for new mine supply to come online. But for all these years, we hadn't seen primary mine discipline until 2017, where we saw Kazakhstan in January of 2017 cut 10% of supply. Then we saw the world's biggest mine, MacArthur River, shut down. In November, they announced they're shutting down for 10 months in 2018. And they basically need $40 uranium to be incented to do that. And that decision is probably going to we're in March. They say they're going to start it in November. What's your thought, Scott, whether or not MacArthur River comes back online if pricing hovers around here?
Yeah, well, my opinion is it's at least 10 months. And for 2 reasons. I think Cameco probably initially pegged the shutdown at 10 months more for Canadian labor laws than anything else. Mm-hmm. Anything more than 10 months kind of triggers a different category of severance and benefits being paid out. 2, I think Cameco would hope that things turn around and they can start back up after 10 months. But they've been quite vocal and said that, listen, if things haven't gotten any better, we're keeping this mine down. I think it's a lot easier to keep a mine down that's already shut in than to make that initial shut-in decision. And, those are big conventional underground mines. There's a lot of moving parts there. To shut in a project like that's not an easy decision. But once it's down, it's a lot easier to keep it down. And I think as they look at the situation now, we're bouncing around $21, $22 a pound. I think they'll have no decision other than to keep it down longer. And I think that will be pretty profound for the utilities who kind of view Cameco as one of the, blue chip suppliers of the big large cap companies. They should be concerned already, but I think, that'll be kind of the last straw that could cause things to really go crazy. But I think you're smart to look at the previous cycles and say, okay, in 2004 to 2007, what caused the uranium price to go from $10 a pound to $137 a pound? And it was underinvestment on the production side. You had years of low uranium prices, which basically killed the exploration cycles, but also killed any development cycles of new mines. And frankly, I think it even inhibited some capital, sustaining capital investments in existing mines. And we saw, that come to fruition with a couple very large supply disruptions in Australia, in Saskatchewan, and that was what it took to really kind of light the fire of that market. But, we also had the nuclear renaissance coming about during that period. So you had, underinvestment in the supply side meeting the nuclear renaissance. Well, the nuclear renaissance did pan out, maybe not as big as we had hoped, but, a lot of reactors around the world, have been initiated and are coming online as a result of that. But I would argue that the period that we're in right now, which is driven by China and India and the Emirates and maybe now the Saudis and other countries, this is a whole new wave of development, which is kind of a different kind of nuclear renaissance, and it's driven by emerging markets who have no other choice but to build nuclear power plants, given the air quality issues that they face, carbon emissions, and just need for base load 24/7 power. So I think it's smart to look at the conditions, and you're right, there were a lot more, a bigger group of mines being developed back in that time than we have now. I think utility inventories were lower back then than they are now, but I think even utilities in the U.S. with 2 years forward supply of inventory, I don't see that as inhibiting anything once things start taking off here. So it is an interesting analogy to draw, and I think you could make an argument that the conditions are even more positive now than they were back in 2004, 2005.
So I said earlier that security of supply is what's more important to a nuclear fuel buyer and the price they pay. So as I think about that, and you think about, well, what's the fuel cycle for them? And it takes them 18 to 24 months from the time they place an order to the time they get it at the nuclear power plant in the form of nuclear fuel rods. And as you look forward to 2020, you have about 30%, some say as high as 35% of their needs not covered by contract. So if I'm a nuclear fuel buyer the last 7 years during this downturn, I've been able to go into the spot market because the Kazakhs have been there pumping it in, and it's kind of been like a drug for the utilities. And it's further been exacerbated by these carry trades because it's just been there, and it's there. Now, these guys are smart at the nuclear fuel plants, and they know how long it takes them to buy, so they know that their needs. And the U.S. consumes 30% of all the uranium that comes out of the ground. And so you would think that if there's a 2-year fuel cycle and they know that there are some dynamics at work in the market, and they can't be oblivious to THK, because if they are, that's irresponsible. and the impact that the number one player in the world can have on the market. So you would think that they need to start coming into the market. Now, I know in the back half of 2017, some of the utilities came out with RFPs, requests for proposals, that they put to the miners trying to lock up some supply, and nobody bid. The miners didn't like the prices. And so there was a game of chicken that was forming. And my guess would be, and no, it's more than a guess, that's done from primary field work, that they know they need to be in the market right now. And then something called Section 232 came along not a few months ago, when Energy Fuels and UR Energy petitioned the Commerce Department to require the U.S. utilities to buy at least 25% of their uranium from U.S. miners. And the reason they did that, obviously, Scott, you know this, but I'm sharing this with listeners, is at one point, if we went back to the 80s, the U.S., let's frame it, the U.S. today consumes about 50 million pounds of uranium for its nuclear power plants. And back then it was in the, probably about the same, mid-40s, 50-ish million. But back then it produced it could have produced all of its supply. It produced as much. The U.S. miners did.
In 1980, it was over 40 million pounds.
Over 40 million pounds in 80. And then the wall fell. And there was a bit of complacency, the Berlin Wall and with fall of the Soviet Union, and the Russians and Americans, and they had a very good relationship for years. It's not like it is today. The Russians were doing everything they can to befriend us after the wall fell, and now we have a Cold War 2.0, so the geopolitical risks are quite high. And during this time, shockingly, the U.S. has put itself in a position where they don't have a nuclear fuel cycle. They have no enrichment capabilities of its own. It has one conversion plant to turn into UF6, and that's been shuttered for now because of pricing. And the uranium mining industry, which produced 40 million pounds in 1980, produces 2.9 million pounds right now. And it's basically on its knees. And you work for one of them, UEC, and you guys are well positioned in the space. But the whole industry is just really on its knees in crisis mode. And so they have petitioned, the two companies petitioned the industry to the Commerce Department to get some relief there. And from what I've heard, Scott, that the utilities know they need to be in the market, and they would have come into the market this year, but the 232 has delayed that a little bit. Can you share your thoughts on that?
Sure. You're exactly right that, when you hear that a utility has uncommitted needs starting in 2020, as an investor, don't be put off by that, because, you're right, Mike, the procurement cycle needs to begin probably 2 years prior to that need being filled. So it would be logical that in the first and second quarter of this year, the utilities kind of return back to the market in what would be a more normal procurement cycle. And, we had very low years in terms of long-term contracting by utilities over the last, 6-7 years, much lower than average. At some point that has to change to where utilities start to make up for that. Now, we thought it was going to happen. Unfortunately, an unintended consequence of that 232 filing is it has put the utilities in the U.S., kind of on the sidelines until they see how that shakes out and until they understand what the rules of the game will be with that. So, but I wouldn't be put off by that too much. The requirements aren't going away. They're getting much closer to where they have actual needs, and the procurement becomes more actual demand than discretionary the closer they get to those actual needs. So something to watch. And the 232 filing, I think you have to put it in context of the Trump administration, and I'm sure the utilities look at it one way, but I think if you look at it, it doesn't make sense that a country that gets 20% of its electricity from nuclear energy, 60% of its carbon-free electricity, yet is only getting 2% of its uranium supplies from domestic sources. and 20% of its uranium coming from Russia, 40% from Russia, Kazakhstan, and Uzbekistan. Those countries, latter countries that could be impacted by Russian development. So, there is a problem, and I think the Trump administration, would be smart and wise to accept the filing at the Department of Commerce and look into it and see. I think the remedies can take a lot of different forms, and I know the petitioners proposed a 25% quota for U.S. mined uranium. That's certainly one way to do it. There's other ways, and I'm sure those will all be discussed by the Commerce and all the Commerce Department and the interested parties. But for U.S. miners like UEC, who have preserved our assets rather than produce them, we shut in our Palangana mine in 2013 to wait for better pricing. Well, in retrospect, a very good move. We would have wasted 5 years of production into a crummy market. While we're de-risking and getting our assets in Texas and now in Wyoming ready to start up, so we can contribute towards that increased need for domestically mined uranium, with or without 232 filing a petition. We just think it's good business that domestic utilities, would have a bigger component of domestic mines supplied in their portfolio. The real irony in all this is it was, 2 weeks ago, it was found that the Russian government was hacking and engaged in cyber attacks on our U.S. electric grid and nuclear power plants. And at the same time, those electric power companies in the United States are relying on 20% of their supplies of uranium from the Russian government. There's something that is profoundly wrong with that situation. And anyway, I think it'll all be heard over the course of this year. I think the Commerce Department should respond any day now on whether the petition will be heard. And then, of course, we'll go through a process of what can be done to correct the situation.
I will say the bears in the space, their narrative to me is so tired. And I keep waiting for something really novel and new to come out, because the onus at this point in the cycle is on the bulls, right? So it's easy to be a bear at the table and say, yeah, but this, that, and the other thing. And the bulls, if you do your work, you can look at it differently and say, wow, things can change. One of the bears, the part of the bear narrative is, well, if the price of uranium spikes to $30, the Kazakhs will just pump it out like there's no tomorrow. And, one of the things that I like to look at is their method of mining is in situ recovery mining, or ISL is ISR. It's called different things, but it's basically like putting in an oil and gas drill bit in the ground, and you put a solution down and you pull it out through a series of pipes, and it gets processed. And it's a lower cost upfront method of mining. But it can be expensive over time, because you have to keep replacing the wellheads, and that gets expensive. And I think when I think about the cost for the Kazakhs on a cash cost basis, it's obviously the lowest, as we mentioned earlier. But there's when you look on an all-in basis, the cost to maintain those fields and to drill and to do everything else, it's not quite as cheap as people think. What's your view on that, and your view at $30 they're going to keep pumping it out of the ground?
Yeah, well, remember, not all of the mines in Kazakhstan are of the quality of a Karatau mine with cash costs in the high teens. That's unusual. Other mines have deeper deposits, have higher acid consumption, and so they have a whole range of operations. But you're right; they need new capital coming in for new developments. They'll need sustaining capital coming in for existing mines. So I don't think you should view Kazakhstan as a bottomless pit of supply. Under conditions, when I arrived 2.5 years ago, they were already looking at a peaking of supply as it is in this period of production, peaking out and falling back down, absent of new mine development. And so I think what they've done with some of these production cuts is try to just bulldoze the peak off a little bit and push it out into the future. So, I think there's a limit to how much they can respond. There'll be some ability to respond, but I think when you add up everything that's out there at a very cost competitive level, you're still needing new mine supply coming now, in the next 5 years, which isn't going to happen with no incentive pricing present for people to spend the capital to do it. Again, that's where I kind of like our positioning as an ISR producer in the U.S. We have operations which are quite scalable, can respond quite quickly, and at a low, we had $22 cash cost out of South Texas at Palangana. So, we think that's we can replicate that at Burke Hollow, and certainly the Powder River Basin has very competitive ISR resources as well. So, we're anxious to be able to scale up and meet that. But, if you step back and you look at the global supply and demand, if all the U.S. ISR producers all ramped up their operations, it would be very profitable for them in a $40 market. But it's not going to bring out enough pounds to really stem
not even
uranium.
Not even close. Right. What that's the thing is for the U.S. miners. Yeah, it's good, but with the deficit that I see right now, I know some argue there's a surplus. I could not disagree more. I think the world is in a serious deficit right now, and that's only going to be exacerbated in the next several years with no new production coming online, mine closures, and the cascading waterfall of new reactors coming online, who, by the way, use 2.5 times the amount of uranium, some say 3 times on an initial fuel load. But yeah, so if the U.S. comes online, it seems to me, if everything was produced, it still wouldn't really matter that much. But except for the U.S. miners, it would be good.
It'd be good for us, but it wouldn't.
Yeah, it'd be great for the U.S. miners, but to the world supply-demand deficit, it doesn't impact it terribly. So, any parting words for the listeners?
Well, no, but I think that's the investment thesis for uranium right now, and I think you've touched on it. It's awfully easy to just fall into the conventional wisdom that, the market's oversupplied, there's too many inventories, this and that. But when you really start to peel back the layers and you look at the fundamental developments we've seen on production cutbacks, on the DOE ceasing their transfers, you're seeing even underfeeding will decrease in coming years, and above ground inventories are being consumed much more rapidly now with these production cutbacks. We can get back in balance much more quickly than we anticipated even 2 years ago. Demand, I think you're seeing around the world, continued growth in nuclear power, driven by the emerging markets. So I think as investors, we're looking for these unique opportunities to take advantage of things where perhaps everyone else doesn't see them. I mean, if everyone saw this, then it wouldn't be an investment opportunity. But Mike, I think you're on the right track here to really dig deep on all these various factors and keep your listeners advised. So it's really been a pleasure to visit with you today.
I'm sorry, was that an Arizona State Sun Devil just complimenting an Arizona Wild?
You're my best friend from U of A.
Scott, thanks. We'll speak soon, and I'll have you back on.
Yep, sounds good. Thank you, Mike.
Okay, thanks, buddy. Take care. Bye-bye. So I hope you enjoyed the interview with Scott Melbye, president of UEC and 30-year industry veteran. If you're a contrarian investor, uranium's a space. Like I said, for me, it is the best risk reward of any industry I've ever seen. And it doesn't happen overnight. You have to be patient, and it could take a little while, right? I've been looking and talking about the space for a year, but I'm looking downside versus my upside. And, I think it's just the asymmetry is spectacular. So I will be back next week. I hope you enjoyed, like I said, the conversation with Scott. We'll be back next week. I have a very interesting guest for you that's already pre-booked. Hope you have a great week. Happy investing.
The information presented on Talking Stocks Over a Beer is the opinion of its hosts and guests You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.